Welcome back to the Working Thesis. Today is Thursday, July 9th, 2026. Yesterday, we saw the market aggressively sell almost everything under a combined oil and interest rate scare. But today, the market came right back and bought almost everything back. The catch is that they did it selectively.
Exactly. Yesterday was a broad-based, indiscriminate risk-off event. Today, the bid specifically went to the second derivative AI plays. We are talking about the memory makers and the chip equipment companies that supply the entire industry.
We saw that lit up by the news of SK Hynix's US listing, as well as Meta confirming they are building their own custom chips. Meanwhile, the crowded leaders, like Nvidia, Alphabet, and the other megacaps, essentially sat this one out.
Which is the signature of a broadening AI trade, rather than a topping one. When capital leaves the primary leadership but stays within the broader thematic ecosystem, that tells you the fundamental demand remains completely intact. Capital is just looking for the next layer of the supply chain.
Right, and those next layers are the critical bottlenecks. If you are going to build custom silicon, you still need the equipment to manufacture it, and you still need the high bandwidth memory to make it run.
Precisely. It is a rotation toward the physical constraints of the AI build-out. The capital is moving to where the supply is tightest, which is exactly how a healthy, durable thematic rotation operates on a day-to-day basis. First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you. Let's look at how that played out on the scoreboard today. The Dow was the relative laggard, up just 0.27%, closing at 52,487. The S&P 500 gained 0.81%, reclaiming that 7,500 level to close at 7,544.
And then you look at the tech and the small caps. The Nasdaq led the majors, up 1.3% to 26,207, heavily driven by the semiconductor space. But the Russell 2000 was right behind it, jumping 1.22% to close at 2,993.
Meanwhile, the VIX, Wall Street's fear gauge, collapsed. It fell 6.3% down to 15.84. This is practically the mirror image of yesterday's risk-off tape, isn't it?
It is the exact mirror image. Yesterday, we saw the VIX spike as capital panicked over the geopolitical headlines. Today, the fear completely drained out of the room. The fact that the Russell 2000 caught such a strong bid alongside the Nasdaq shows that risk appetite didn't just return to the safest names.
It sought out beta across the board, moving further out on the risk curve. Small caps participating like this alongside a tech rally is the definition of a broad market bid.
Absolutely. When fear deflates that rapidly, it forces capital that was hiding on the sidelines right back into the market. And today, it chose to step into the areas that had been previously overlooked.
That broadening was very evident in the sector performance. We had 8 of the 11 sectors closing green today. That is a stark contrast to yesterday, where we saw 9 sectors finish in the red.
Breadth returning to the market is exactly what you want to see if you're looking for durability. Technology was the clear leader, up 2.18%, which we will dig into shortly. But it wasn't just tech carrying the water today.
No, it wasn't. Consumer discretionary rose 1.34%, and financials gained 1.04%. The banks were particularly strong, up around 3% overall as they head into next week's earnings season.
Capital is clearly positioning itself ahead of those bank prints. On the flip side, the defensive and commodity-heavy sectors lagged. Consumer staples fell 1.4%, and the energy sector also dropped 1.4% on the back of lower oil prices today.
It is a classic risk-on alignment. When financials and discretionary are marching upward alongside technology, while staples and energy act as the funding sectors, that is a market expressing confidence in the underlying economic engine.
It shows a willingness to look past the immediate noise and focus on growth. The breadth data today confirms that the rotation we saw was systemic, not just an isolated move in a handful of tech stocks.
The absolute star of the day was the semiconductor space, specifically memory and equipment. We had 2 major catalysts. First, SK Hynix's US ADR debut was 7 times oversubscribed, which is a blunt, real-time read on just how massive the demand is for the memory supercycle.
That level of oversubscription is staggering. SK Hynix is the linchpin for high-bandwidth memory right now. When the market demands their shares that aggressively, it is directly pricing in the forward demand for HBM across every single major AI data center build-out.
The second catalyst was the news that Meta is designing its own in-house AI chips. That sent the entire chip equipment sector soaring because anyone designing custom silicon still has to actually manufacture it.
Exactly. The fabs need the tools. Applied Materials rose 3.2% today. Lam Research jumped 6%. Micron was up 4.5%. And SanDisk climbed 7.6%. It was a clean sweep across the equipment and memory layers.
The storage names moved too. Western Digital gained 5%, and Seagate rose 3.5%. We also saw ARM jump 9.2% and AMD rise 5.7%. Altogether, the Philadelphia Semiconductor Index surged 4%.
This is the picks and shovels trade in action. If hyperscalers are broadening out their silicon designs, the total addressable market for the equipment makers expands. The tools required to build these next-generation chips are the ultimate supply-side bottleneck.
Here is the crucial nuance of today's price action, though. This was not a mega-cap-led melt-up. The usual suspects actually sat this out. NVIDIA fell 0.66% today. Alphabet dropped 0.69%.
We also saw enterprise software take a breather. Salesforce fell 2.45%, and Palantir dropped 2.41%. So you have the semiconductor index up 4%, while the definitive market leader, NVIDIA, closed slightly red. That is incredibly telling.
Money left the crowded NVIDIA and mega-cap trade and moved directly into memory, chip equipment, and small caps. It was a rotation occurring entirely within the semiconductor and technology ecosystem.
Which proves this is not a story of weakening demand for AI. If the AI thesis were breaking, you would see capital flee the entire sector and hide in staples or utilities. Instead, it rotated toward the supply-constrained layers.
It is fanning out. Capital is looking at the valuation and the crowded positioning in the megacaps, and then looking at the fundamental utility of the equipment providers and making a rational allocation shift.
Precisely. Broadening within a theme is the hallmark of a structural shift. The market is recognizing that the AI build-out is far larger than any single company, no matter how dominant that company has been in the initial phase.
Let's look closer at Meta because they had a massive day, rising 4.7% on a trio of major developments. First was the news about their in-house custom AI chips, which we just discussed.
Second was the launch of their new Muse Spark Developer API, which is aimed at expanding their ecosystem. And third was a widely cited note from SemiAnalysis arguing that Meta could reach the frontier model tier within about 6 months.
That timeline is turning heads. Meta joining Google and Amazon in successfully designing its own AI silicon shows that the custom silicon wave is widening rapidly among the hyperscalers.
It changes the dependency dynamic. When Meta, Amazon, and Google all design their own silicon, it accelerates the broader ecosystem. It means more diverse architectures, which in turn requires more specialized manufacturing and more equipment.
It also reinforces why the market bid up the equipment makers today. If the hyperscalers are racing to build frontier-tier models using diverse, proprietary silicon, the capital expenditure cycle is going to remain extremely robust.
That is the core takeaway. Meta's push into the frontier tier proves that the AI arms race is only intensifying, and the capital being deployed to reach that frontier is securing the revenue streams for the entire underlying supply chain.
Shifting to the macroeconomic picture, the geoeconomic scare from yesterday faded significantly today. Even though overnight U.S.-Iran strikes continued, WTI crude actually fell about 2.4% to around $71.75.
That drop was driven by reports of active mediation from Qatar and Pakistan, combined with the reality that tankers are still successfully crossing the strait. The geopolitical risk premium in oil is actively deflating.
We saw safe haven flows modulate as well. Gold rose about 1%. But the 10-year Treasury yield eased back down to 4.54%. Capital is digesting the news and reacting to the actual physical flow of commodities.
With oil falling despite the persistent negative headlines, the market is effectively voting for de-escalation. When price action ignores bad news, it tells you a lot about how institutional capital is assessing the actual probabilities of disruption.
It also removes the immediate stagflation fear that gripped the market yesterday. If oil is contained in the low 70s, the pressure on the Federal Reserve to maintain restrictive rates due to energy inflation is somewhat alleviated.
Exactly. It gives the market breathing room to focus back on corporate earnings and secular growth themes, rather than obsessing over an exogenous supply shock.
Another through line that kept confirming today, even in a broadening market, was power and physical inputs. Bank of America reiterated today that the U.S. could face a large AI-driven electricity shortfall.
Power constraints are the hardest physical barrier in the AI build-out. You can design the fastest chip in the world, but if you cannot secure the baseline load to power the data center, the chip is useless.
We are also seeing constraints in the materials required for this transition. Rare earths are back in focus. MP Materials is facing a talent crunch, plus they are dealing with a new lawsuit. It is another physical inputs pinch point.
It highlights how fragile the physical layer of the supply chain is. And on the flip side, we are seeing real divergence in the cloud space. One GPU rental named CoreWeave is now trading around 40% below its highs, near $90, well off a peak up above $150.
That is a steep drawdown from its highs for a neo-cloud player. It looks like they are being left behind by this leadership rotation, as capital focuses on the absolute necessity of equipment, memory, and power generation.
When the initial frenzy cools, capital becomes highly selective. The infrastructure layers with the deepest moats, like the equipment monopolies and the physical power grid, are catching the bid, while the middlemen face multiple compression.
Underneath this risk-on tape, there were a few single-name cracks worth noting on the consumer front. AstraZeneca fell about 6% on a trial failure, which is idiosyncratic, but there were broader signals.
Yes, PepsiCo dropped about 3% on mixed results, and Levi's fell about 2%. We also saw Costco soften on reports of decelerating sales. When Costco slows down, you have to pay attention.
Costco is often viewed as the ultimate bellwether for the resilient middle-class consumer. Seeing their sales decelerate is an early consumer yellow light that is flashing beneath the surface of today's tech rally.
It suggests that consumer wallets are becoming exhausted. While the enterprise side of the economy is spending heavily on AI infrastructure, the traditional consumer is starting to pull back on discretionary and even staple spending.
It creates a two-speed economy. The AI and infrastructure side is booming and supply constrained, while the consumer side is showing signs of fatigue. It is a divergence that we will need to monitor closely as earnings season begins.
Definitely. The consumer data is the counterweight to the AI euphoria, and it will dictate the broader macroeconomic trajectory for the second half of the year.
We got two fresh macro prints today that speak directly to that trajectory. First, U.S. labor. The Department of Labor reported initial jobless claims came in at 215,000. That is below the 218,000 estimate and down from 217,000 last week.
So the labor market is still firm and only slowly cooling. But the second print is much more thematically interesting. China just exited factory gate deflation. The National Bureau of Statistics reported China's June producer price index rose 4.1% year over year.
That is the strongest reading in about 4 years. It ends a multi-year factory gate deflation streak, marking its fourth straight monthly gain. Meanwhile, China's consumer inflation cooled to 1%. The producer price turn is being driven by energy and raw material input costs, plus robust AI and semiconductor export demand.
This is an incredibly important data point, but we have to frame it carefully. This June print predates the late June Strait of Hormuz oil spike. June actually reflected lower oil prices as Middle East tensions had eased earlier that month.
Right, so we must not tie this June data to the recent conflict. The Hormuz spike is a July forward inflation risk, and it is not reflected in this number at all.
Exactly. What this number actually reflects is the core industrial engine turning back on. The demand for AI hardware and semiconductors is so strong that it is actively pulling China's factory gate prices out of a multi-year deflationary slump, entirely separate from the recent geopolitical noise.
That brings us to the big question, framing the entire market right now. Is the AI trade topping, or is it simply broadening?
Based on the evidence today, the read is that it is broadening. Capital is fanning out from the obvious, crowded winners, like NVIDIA and the megacaps, and flowing directly into the picks and shovels layer. It is moving into memory, into equipment, and into the small caps.
And it is moving exactly to where the supply bottlenecks are most severe. Capital is seeking out the physical constraints of the build-out. That is the signature of a broadening, healthy trade, not a cyclical top.
And we are seeing a real economy echo of this financial rotation. China's producer prices turning positive, lifted partly by that very same AI and semiconductor export demand, plus commodity input costs, shows that this demand reflation is showing up in the physical economy.
It is happening simultaneously. The physical economy is reflecting the same supply constraints that the stock market is pricing into the semiconductor equipment makers, even as the U.S. labor market stays remarkably firm.
This is a likelihood game. No one can predict the future, just one read of what the setup looks like today. But the setup today points to a durable, widening cycle rather than an exhausted one.
Looking at the week ahead, the calendar really starts to heat up. We have bank earnings kicking off around July 14th. That will be a crucial read on consumer credit and delinquencies, especially after we saw Costco soften today.
Also on the 14th, we have AEHR, followed by ASML on the 15th. Then on the 16th, we get Alcoa, Intuitive Surgical, and TSMC. That TSMC print will be heavily scrutinized for forward commentary on the exact bottlenecks we discussed today.
Then we move into a massive cluster on the 22nd with ServiceNow, Tesla, GE Vernova, and IBM, culminating with Microsoft on the 29th. We also have CPI data next week, which will be vital for the Fed's trajectory.
We will also be watching the follow-through on the SK Hynix ADR to see if that massive oversubscription translates into sustained price momentum. And of course, we are keeping a close eye on the Strait of Hormuz mediation efforts.
There is a lot of data to digest over the next 3 weeks. The market will be looking for validation of this broadening thesis across both the semiconductor supply chain and the broader consumer economy. To wrap up with the net thesis read, the bottleneck thesis broadened significantly today. We saw memory and HBM confirmed by SK Hynix's blockbuster demand. We saw chip equipment confirmed as the tools every fab needs.
We also saw the custom silicon wave confirmed by Meta joining Google and Amazon, and the power constraints confirmed by Bank of America's shortfall call. All of this occurred while the crowded NVIDIA and megacap trade lagged.
Which tells us semiconductor demand is intact and widening. This is a rotation within AI toward the supply-constrained layers, not weakening demand. And the macro tell supports this. China's June PPI turning positive on AI exports is a real economy echo of this exact reflation, even as U.S. labor remains firm.
Most importantly, no thesis kill criteria fired today. The foundational drivers of the thesis remain intact, and capital is simply reallocating to the most constrained layers of the architecture.
That does it for our review of Thursday, July 9th. Thanks for walking through it with us.
Thanks for listening. We will see you next time. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself, and keep asking good questions.